Ladies and gentlemen, good day and welcome to the Q4 and FY'25 earnings conference call of Khadim India Ltd, hosted by MUFG Investor Relations. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. I now hand the conference over to Ms. Masoom Rateria from MUFG. Thank you, and over to you.
Thank you very much. Good evening, everyone, and welcome to Q4 FY'25 earnings call of Khadim India Ltd. Today, to discuss the results, we have with us Mr. Ritik Roy. So, we take the truth and the comments. Again, the Q&A session. The conference contains certain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date. The actual results may differ materially. The statements are not involve risk and uncertainty that are difficult to predict. I now hand the conference to Mr. Ritik. Over to you.
Hello. Good evening. I hope I am audible. On behalf of Khadim India Limited, I am pleased to welcome you all to today's conference call, where we will be discussing our Q4 and FY'25 results. We sincerely appreciate your time and interest in our company's performance, and we hope you have had the opportunity to review the financial results and investor presentation available on the stock exchange. The global macroeconomic environment during the quarter remained challenging, with shifts in consumer spending behavior leading to a muted demand. Despite these headwinds, we maintained steady revenue growth, with Q4 revenue at 149 crores, which is up 3.8% year-on-year. Gross margin improved by 68 basis points, driven by volume growth and better cost control. One of the key milestones during the quarter was the successful completion of our demerger process. The scheme of arrangement for transfer of distribution business of Khadim India Limited into KSR Footwear Limited has been approved by the Honorable National Company Law Tribunal, Kolkata bench, via this order dated 27th March 2025. The said scheme has been effective from 1st May 2025, and in terms of the said scheme, all the assets and liabilities as demarcated pertaining to the distribution business of Khadim stands vested with KSR Footwear with effect from the appointed date, which is 1st April 2025. KSR Footwear will be listed shortly, and we believe this strategic move will enable sharper focus and better performance across both the retail and distribution segments. We are targeting break-even in the distribution segment by FY'26 with a renewed focus on cost reduction and sales growth. The retail business will continue to drive performance with a two-pronged approach, maintaining value-focused pricing under the Khadim brand and premiumizing our sub-brands through price enhancement. Looking ahead, we are excited about the launch of our new athleisure segment in the upcoming spring-summer season. This price-sensitive range, combined with our higher-margin products, is expected to contribute positively to our gross margin in the coming quarters. As a part of our cost efficiency measures, we have also shifted some e-commerce warehouse operations to e-cart logistics, allowing us to benefit from their scale and expertise while converting fixed overheads to variable cost. As of FY'25, our retail store network stands at 886 stores, with 14 new stores already added during the year. This includes 213 company-owned outlets and 673 franchise stores, reflecting our continued commitment to an asset-light expansion strategy. Looking ahead, we are optimistic for FY'26, expecting volume growth driven by reduced MRPs and new product introductions. Now moving on to our financial performance. Quarter 4 FY'25. For the quarter, we reported revenue from operations of 149.1 crores, reflecting a 3.8% year-on-year growth. Our gross margin for the quarter stood at 46.9%, up by 62 basis points as compared to the same period last year. EBITDA for the quarter stood at 15.18 crores. EBITDA margins for the quarter stood at 10.2%. Profit after tax Q4 FY'25 was 0.92 crores, showing a 10.1% decline year-on-year with margins at 0.6%. For the year ended FY'25, revenue stood at 623.7 crores with a slight increase of 1.4%, and gross profit margin stood at 46.7%, which has improved by 130 basis points through our consistent efforts in premiumization. EBITDA for the year stood at 66.6 crores with an EBITDA margin of 10.7%. Profit after tax for the year stood at 5.06 crores and PAT margin stood at 0.8%. Looking ahead, we remain confident in our strategy and proactive approach. We are committed to building on our strong brand, expanding our retail footprint, and innovating to meet evolving consumer demands. We believe that these efforts will yield positive outcomes in the coming quarters, and we are excited about the opportunities ahead. With that, I conclude my update, and I'm happy to open the floor for any questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Arnav Sakhuja from Ambit Capital. Please go ahead.
Hi. Thank you for taking my question. So I want to know, in the retail segment, how many stores are we planning to open in FY'26?
In retail, we are planning to open around 50 stores, combining of COCO and franchisee in FY'26.
And what would be the mix of COCO and franchisee amongst these 50 stores?
Around 7 to 8 COCO and balance franchisee.
And is there any revenue and profitability guidance you can give us for the retail segment in FY'26?
Retail means, as we have told that we have reduced the MRP in our Khadim brand, so there will be some margin reduction in that. So for that, maybe in the first quarter and in the second quarter, there will be some gross margin reduction. However, we think that will be combat with the value growth. Already we have seen this year there is in FY'25 the value degrowth has stopped. We are static at means whatever we have the volume we have sold in FY'24, we have sold the same volume in FY'25 also. In the last 3 years, there was continuous volume degrowth. So I think we will be able to increase the volume. That will increase the value sale. However, the margin will be slightly in the lower side.
And just one more question. So, as you mentioned in your opening comments, and as we discussed in the last quarter call as well, you've been piloting an athleisure segment, this new segment. So, would the margins be better for this segment? What would be the margins in the athleisure segment?
Athleisure margin will be more or less same as of footwear. We have kept value-based product so that the more volume uptake is there, because in the athleisure segment there is a lot of competition. If we keep a higher margin product, I think that will not be able to sell from our store. So we have kept at the same level of margin what we generally get in our Khadim product. So more or less the margin will remain the same, but it will increase the value sales for our store with no cost, because already we are incurring fixed costs in the store.
Okay, thank you for answering my questions.
Thank you. Next question is from the line of Bhargav from Ambit Asset Management. Please go ahead.
Yeah, good afternoon, and thank you for the opportunity. So my first question is that, is there any timeline on the listing of KSR footwear?
We are already in that timeline zone, but what has happened is that in the NCLT order, there is a transfer of authorized capital from Khadim India to KSR, which is pending in the MCA. So once that thing is done, which will be done within this week, we will be announcing the record date, and the listing process will also start.
So at best in a month's time it should get listed, right?
Yes. We are already in it.
Okay. Second, what is the debt reduction plan in the retail business? Because I believe there will be close to about 100 odd crores of debt on the retail business.
Yes, we have a plan of reducing the debt, but that depends on the cash flow and also the profitability of the business and some extraordinary income. So whatever cash is generated in excess of what is required will be used for reducing the debt. In the last 2-3 years, we have already reduced the debt from 125 crore to 100 crore, and we will be again in the process of reducing the debt.
Because if I look at your FY'25 operating cash flow in the retail business, it's closer to 44 odd crores, right?
Yes.
So then we are generating good cash flows to sort of. So is it fair to say that in 2 years' time we should be debt free in the retail business?
So that will be an aggressive statement, but we'll definitely try. Another thing is that we have creditors also. We also need reduce the creditors debt so that the working capital cycle is also improved. So taking both the things together will definitely, if the cash flow comes in, we will reduce the debt, because our debt is mainly working capital debt, is a credit type of thing. So whatever excess cash you park in the cash credit account, your interest is saved.
Okay. And as both companies become separate, do you envisage any increase in fixed cost because there will be some duplication, or you don't think?
Yes, in some cases, like the audit fees and all these things, there will be, but the two, we are maintaining the two departments, so the costs are totally different, and maybe some common expenses like the NSE, BSE fees and all these, that will be incurring in both the companies. I mean, that is not a very big amount, but that there will be some duplication.
And lastly, I mean, on the distribution side, we have a factory in place, whereas in retail we do most of outsourcing. But now with the demerger, is there any change in plan, or we continue with our in-house manufacturing on the distribution side?
The in-house manufacturing will be catering to the distribution, but some product which we used to take from our manufacturing division, Khadim India will purchase it from KSR Footwear Limited.
Okay, sir. Thank you very much, and all the very best.
Thank you.
Thank you. Participants who wish to ask questions may please press star and 1 at this time. I repeat, to ask a question, please press star and 1 now. Next question is from the line of Divyesh Daglia from Neo Wealth and Asset Management. Please go ahead.
Oh, hi. I had a couple of questions. Number one, I wanted to firstly ask with respect to the balance sheet split that we're going to see between both the businesses of KSR and Khadim India. How much is going to be split to the distribution business, and what proportion will stay in the company itself?
The assets that are that are eligible for that are used for the distribution business has been transferred to KSR Footwear Limited, like the factory machinery molds, the factory buildings, the warehouse that caters to the distribution business. All the movable assets of this division have been transferred to this KSR. And in Khadim, hello.
Sorry, yes.
And the retail assets has been kept in the Khadim India Limited. We have already the assets detail has been given in our SEBI results. Which assets has been and in the demerged entity, means in the discontinued operation, has already been given. If you want a detail, we can provide that same.
Yes, please, that'll be helpful. And I just wanted to understand the loans and the borrowings we have in our books, that is not against any of these factories, or it's not pledged against any of the fixed assets, right? They're against personal guarantees.
Loans are generally of cash credit nature, so some portion of the cash has been given to the KSR Footwear, and 100 crores of loans are kept in Khadim India Limited.
So I believe the split is 120, so that's 100 with Khadim and 20 with KSR.
Yes.
Okay, thank you so much.
Thank you. Next question is from the line of Anupam Jain from Indira Securities. Please go ahead.
Thanks for the opportunity, sir. What is the update regarding Punjab dues?
It is pending before the High Court. Already we have got a date, and I think that has been done on 19th of this month, and the next date would be in the month of July. We are in one of the bidder has already got the payment, and we think that we will definitely get it within this financial year.
Okay. My primary question is also that why are we taking this case in court?
Because we have got the arbitration order in our favor. For that, against the arbitration, the government has moved to the court.
Okay. And the UP government that you have received till now?
Yes. All the complete payment of government has been received.
Okay, so Punjab government is still pending 25-26 crore rupees that was pending.
Around 32 crores. 32 crores.
Around 32 crores. Okay. Thank you.
Thank you. Participants who wish to ask questions may please press star and 1 at this time. I repeat, ladies and gentlemen, to ask a question, please press star and 1 at this time. The next question is from the line of Raj Patel from RK Securities. Please go ahead.
Thank you for the opportunity. Just two quick questions from my side. So, can you please elaborate on what specific changes have you been observed in customer behavior and spending patterns, and how are you evolving the consumer preference, influencing the product development, pricing, and marketing strategy? Apart from that, is there any notable shift towards online or omni-channel purchasing, and how is the company adapting to this trend?
Yeah, thank you for the question. So, regarding the consumer preferences, what I can say is that while there was over the past many months, there was a little bit of a inflationary pressure. Because of that, we have taken the call of reducing prices in our mother brand Khadims. So because of that, as the CFO mentioned a while back, last year we were able to arrest the volume degrowth. We had to give discounts and all these things. So pricing wise, that is one consumer trend is there, that they are looking for some sort of value. But having said that, it's not that they are looking in all products for value. There is also a segment of consumers in our country that are looking for value-added products. Like one is total value, another is value-added products. So there also we have done a lot of work in our sub-brands. We are changing a lot of elements in our products. We are changing historically whatever soles we were using. We are trying to use better soles, better materials, better. We are trying to give better comfort into our products. We are trying to make our products less serious looking because of the the casual need of the consumer. The consumer wants to wear casual stuff. Okay, so all of that work is also going on. A lot of work has gone on behind it. Many of it has come into effect, and a lot would come into effect regards to the product in the near future for our sub-brands. Yeah. And regarding the online bit, online people are consuming products online, but you need to promote the online products digitally, which we are doing, and I would say online is not as upbeat as it used to be during COVID times, but it still has its fair share. A lot of people are buying online, but the other part is because most of the brands are offering discounts now, almost 6-7 months in a year. So the discounts that you get on your on your e-commerce sites, you are also getting it in the stores. So that way also the sale is happening from the store also, who are looking for the discount.
Okay. And my second question was, what is your outlook on the consumer demand trends for the upcoming quarters, and how does the company expect this to impact the revenue growth? Additionally, could you provide the guidance on anticipated margin and any key factor that may influence the probability going ahead?
Yeah, see, sorry, can you just repeat the question once again?
So, what is your outlook on consumer demand trend for the upcoming quarters, and how does the company expect this to impact the revenue growth? Additionally, could you provide guidance on anticipated margin and any key factors that may influence the profitability going forward?
Okay. So the consumer trend in the upcoming quarters, I mean, it should be good. It should be better than before, of course. But inflationary pressures remain, but this premiumization trend is there. Then I will not comment now, but we are looking for some collaborations, also brand collaborations, etc. So through that also we expect to have more premium customers walk into our store, so that they can consume that product also, and they can they can have a look at our sub brands also. So that is that trend is there, premiumization trend is there, and the value customers, we have reduced the prices. We expect volume growth from that in the coming quarters. Along with that, we have also changed certain policies regarding the channels that we use for selling our products, which is franchisee, then company-owned outlets, and then we have changed certain policies. So we, due to the change in those policies, we are seeing renewed sales growth in many a strong market of ours in Assam, Bihar, and many other eastern zone states. So keeping all these things in mind, I will not give any number, but we are all hopeful that we will have a good sale growth in the coming quarters.
Okay, that was all from my side. Thank you.
Thank you. Next question is from the line of Sahil Bora from ANS Associates. Please go ahead.
Good afternoon, sir. So I have a couple of questions. My first question is regarding e-cart logistics. So the shift of warehouse operations to e-cart logistics is noted as a cost efficiency measure. So can you give us some quantifiable cost savings and operational improvements expected from this transition?
So mainly we have shifted our e-commerce operation from our own warehouse to e-cart. So in our own warehouse, it was related a fixed cost thing. So when we move to this e-cart, it is a nature of variable. How much article we keep in that e-cart logistic, the cost is dependent on that. And in terms of the infrastructure, their infrastructure is much better compared to us because they deal with this e-commerce business. They have all these things which reduces the sales return, and also we can do the claim at the proper time. And in terms of cost, there is around 20% of cost reduced from whatever cost we are doing in our own warehouse.
Okay, sir. And how has this affected the company's fixed versus the variable cost structure?
As I told you, the cost in terms of fixed cost that we are doing in our own warehouse through our own workers and through our own rented place, that has gone out, and in place there is a cost in terms of it's the nature of variable thing, how much we sell per unit cost. If we sell more, then the cost will be more. If we sell less, the cost will be less. But in terms of if we keep the same number of items, we have seen the cost has reduced by 20%. And also we are able to get better infrastructure and better service to our customer.
Yes.
That sounds promising, sir. Sir, I wanted to know if there are other similar efficiency initiatives underway or planned.
Yes, already in our own warehouse, we have implemented a new system. We used to the software that we used to do in our warehouse was our homegrown. Now we have shifted to D365, Microsoft D365 WMS, and we have already implemented the first phase. In the second phase, we have all this. We can means all the stocks will be from the rack. It can be built so that the FIFO basis of means in the physical count also we can do the FIFO basis of billing, which will improve our the stock aging can be improved drastically, and also the obsolescence of stock can be reduced. So these type of things are already in the pipeline, which will first phase is already implemented. The second phase will be implemented after the festive season.
All right, understood. So my next question is regarding the expansion of the retail store network. So the retail store network has expanded by 18 new stores, which includes both company operated and franchise outlets. Sir, I wanted to understand the strategic rationale for maintaining this mix, and how does the company ensure consistency in brand experience across the franchise stores?
We have last year we have also closed our cocoa around 30 own store because they were loss making. So we have taken a conscious call that in terms of loss making store we will not keep it, we will just close it, and we will open a store where the rental is less and comparatively the cost is lower. So that's why you can see only 18 has been added, but 30 store of cocoa has also been closed. So effectively, it will be a 48 store has been opened. And also in terms of combination, we generally keep more on around 80-20 ratio of our own store to franchisee, because in our own store there is capex also, and in case of franchisee the capex is on the franchisee. So this ratio will be maintained so that the efficiency in the capital can also be done and the sales can also be increased.
Understood. And sir, lastly, what are the growth targets for store additions in FY'26, and which markets or formats are prioritized for expansion in the retail network?
So, as I have already told, 50 stores, and that will mainly be in the eastern, northeastern side of the country, because and also in the southern India. So, because in this geography the brand is very prominent, and out of that around 7 to 8 would be our own cocoa store, and balance would be franchisee. Franchisee, it will be a combination of both EBO and FRM. FRM means from we send the stock to the franchisee, and in case of EBO we sell the stock to the franchise. So there it will be a method, both the methods taken together will be around 42 stores, and cocoa around 7 to 8 stores.
Got it, sir. Thank you for the detailed responses and all the very best. Thank you.
Thank you.
Thank you. We take the next question from the line of Akhil Parekh from B&K Securities. Please go ahead.
Hi, thanks for the opportunity. So I have three questions on the retail business and one on the distribution front. The retail, if I look at it, our gross margins have declined over last 4-5 quarters, and in one reason you have said that we are giving more push to volumes. Is it now safe to assume the gross margins which we clocked in FY'25 at around 56%? We are closer to bottom now, and from 26 onwards, we should see stabilization in the gross margins and hopefully improve from there on. That's my first question.
No, I think there, because if you see in the last year, in the last 2 quarters, we have reduced the prices of Khadim, and the margin has come down. But this year it will be full year of operation of the lower prices. And in certain categories, in children product, in school, we have also taken a conscious call of reducing the price because of the economy. So I think the margin is has not come down, but in FY'26 it will come to a level playing field. Means in FY'26 margin will be the margin that will be sustaining for the next years. However, as our MD told, that in the sub-brands, in some sub-brands, there are some product where we are increasing the margin, seeing its demand and the acceptability. So with that also we will try to improve some margin, but in FY'26 we will bottom out in terms of the margin. Hello?
Yeah, hello. Hello. What would be safe assumption for margins basically for 26?
So it's purely dependent on the volume thing, how much the combination of Khadim and sub-brands. So at present I cannot predict what will be the margin, but it will be lower than whatever we have done in this year.
Okay. Fair enough. And would you be able to give the pre-Ind AS margins for FY'25 for our retail business?
Can you come back again?
The pre-Ind AS EBITDA margins for the retail business for FY'25.
Just a minute. It is around 15.61.
Sorry, 15.61.
61.
No, but these are post-Ind AS margins, right? Not the pre-Ind AS.
Around 4% is the rent cost, so you can subtract it from that.
Okay, so around 11.5% is the pre-Ind AS margin for FY'25.
Yes.
Okay, and just last 2 more questions. One is, would you be able to quantify the interest and depreciation cost for the retail business for FY'25?
Yes, already that has been given in our SEBI thing. Retail and this is the result that has been given in the SEBI thing is for retail only. and the depreciation for the
Okay. Yeah. Sorry, Mike. Sure. Got that point. And lastly, on the distribution front, would we expect this business to turn PBT positive from this year, FY'26?
Now, FY'26 we will definitely be in the EBITDA positive, but it's dependent on other factors also, the volume and the prices. But definitely in FY'27, with the lowering of cost reduction initiative that will be taken this year, we will be profitable in KSR in FY'27.
Okay, great, sir. That's all from my side, and best wishes for coming quarters. Thank you.
Thank you. Next question is from the line of Bhargav from Ambit Asset Management. Please go ahead.
Sir, just clarification. When you mentioned that margins in the retail business may be lower because of price cuts, you are referring to gross margins and not EBITDA margins, right?
Yes, gross margin.
So because of volume growth, there is a case to argue that EBITDA margins can actually expand given the volume growth which can come in the retail, right?
Yes.
Okay. Thank you for the claim.
Thank you. We take the last question from the line of Anupam Jain from Indira Securities. Please go ahead.
Thank you. What will be the ROCEs and ROE for Khadim India Retail for FY'25?
We can come back with this answer to you in one-to-one basis. Okay.
Okay. And second question that I had was, your franchisee store has quite increased since a lot, 5 years if I will have to see the number. From 543 stores, it has reached to 673 currently. But yet, the contribution has not increased that much. So what will be your strategy after the demerger? As the demerger has already happened, what will be your strategy in this?
No, this is mainly because our franchisee, the sale that we book is MRP less a trade discount. For that reason also it is less. And the franchisee in Coco, we book the sale at MRP. So will be a mixture of FRM and TFM where the sale will be in the full value. So there we will see the franchisee contribution will increase, but in previously the sales booking is a discounted value, and also mainly our franchisee consists of tier 4, tier 3 where the sales volume is also less. So both of the taken together, the franchisee sales remains lower compared to the Coco sales.
And overall, what will be the SSG growth? Because I can see in the last 3-4 years there has been no SSG growth.
So SSG growth will come only if the volume increases, because since we are not we are slightly decreasing the ASP. So if the volume increases, then only SSG growth will come. And with the macroeconomic scenario not so good, so we think that is the lowering of the prices in the Khadim brand will improve the volume, and that will bring the SSG growth in our store.
Yeah, volume degrowth has been arrested in the
last financial
that has gone by. So now expected that volume growth would come, and that will give us SSG. Renovation is also being done in stores. That would also give us SSG. So, yeah.
Okay. And this leisure apparel that you're launching, this will be launched in all stores?
Yeah, now we are expanding it to many more stores. In the beginning, it was limited to around 20 stores. Now we are increasing it to around 50 to 75 stores. So we'll slowly expand it. in all stores.
Okay. So when will be fully scaled up, and especially when will this be fully scaled up in your company-owned stores?
It's there in our company-owned stores mainly, and some of it, whichever franchisees feeling confident to keep it, we are also billing it to them. We have a aim to at least complete our entire company-owned stores by end of this year.
So that will stretch your working capital?
No, it shouldn't stretch because we are also canceling lot of designs which we feel is not, it's not trendy enough anymore for the Indian economy. So we are keeping that check in our mind, like nothing should put a stress on our working capital, because we are also canceling lot of designs. We are putting it in discount, trying to take them out, whatever trends we feel does not work anymore for the Indian consumer. So that way it should be fine. Should be.
So you're around looking at 40 stores in your company-owned store to add your FPG segment every quarter.
Yeah, you can say.
Around that much that is what you're targeting, internally.
Yeah.
Okay. And I had a last question. So you're majorly Kolkata and East Side driven company. More in the terms of brand visibility, it has reduced quite significantly in the last 2-4 years after pandemic, and it is much more aligned with the older people. That is what the feedback has been generally. And there is a competitor that is providing much better at a lower price point and a better quality. That is what we are hearing. So how are you addressing that?
Sorry, who is offering what?
So
can you come back again?
Your peer in this segment basically is offering at a lower price point and a better quality, and the footfalls has been low due to that also. That is the feedback that we are receiving. How much light do you want to shed upon this?
No, maybe some of the peers are offering at a lower price. But if you see I don't know where you have got this feedback from, but if you see our product quality, the color combinations and such thing, only problem which we actually had was for the last 3-4 years our prices had increased a bit too much, especially in the mother brand Khadim's. So that's where some people might have said that the product has become too expensive, but we have taken a call on that and we have reduced the prices. But when it comes to the product attributes and the color combination, the look, I think you should do a more thorough research. I don't think it's that much affected. The price we were affected for a while, where we have taken the call.
Okay, fair enough. So, do you think the footfalls will come back? What is your footfall guidance for next year? And what are you targeting internally?
Footfall guidance, we want to grow our pairage. We used to be 1 crore pair few years back, so we want to reach there as fast as possible and then grow beyond that. That would be the footfall guidance. And more than one thing is footfall, and we also want to have we want to have meaningful stores. We will not just to have an unprofitable sale, open store wherever we feel like. We want to have stores in meaningful locations so these things will help us to increase our sale and our footfall. I think there is a lot of scope left in that. The markets that we are in the existing market itself, there are many markets still left where if we focus and open the store, we can increase you are asking for footfall and volume growth, right? The footfall will increase like that. Yeah. Because you have to open the store in
30-40% volume growth.
I won't comment on percentage, but some of the markets which we are focusing now in Northeast and many of the eastern states where we felt that the sale has dropped much beyond what the Khadim brand popularity is in those markets. So now that we are coming back with the full-fledged renovated shops with fresh merchandise in those kind of markets in many eastern locations, I think that would give the increase in footfall for us. That would be the main source of increased footfall.
Okay.
Opening franchisees in these meaningful locations.
May I request that you rejoin the queue for further questions, as there are several other participants waiting.
Just one last question. How many franchisee stores we have taken over? Because we introduced a new model also.
We are planning to. We have taken over almost 50 now. So we'll, as the opportunity arises, we'll take over many more. Wherever it's needed. It's not that we'll take over everywhere, but wherever it's needed, we'll do it.
Thank you. We take the next question from the line of Akhil Parekh from B&K Securities. Please go ahead.
So just one bookkeeping question. What would be your effective tax rate for the retail operations going forward in 26 and 27?
The effective tax rate will be the 25%, 25.2%, because the losses that we have was there in the FY20 and 21 has already been adjusted with the profit for the last 3 years. So now it will be on the whatever taxes that come will have to be paid.
Okay. Yeah, that's all from my side. Thank you.
Thank you. As there are no further questions from the participants, I now hand the conference over to Ms. Masoom Rateria from MUFG for closing comments.
Thanks everyone for joining on the call today. I would also like to thank the management for sparing time and addressing the questions today. We are MUFG, the Investor Relations Khadim India Limited. For any queries, please feel free to reach out to us. Thank you.
On behalf of Khadim India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.
Thank you.